Right, I think we can kick off. So, hello everyone, and welcome to today's session on financial stability and regulation. My name is David Aikman. I have the privilege of co-chairing this session with my former colleague Matthieu Chavaz from the Bank of England. We have four absolutely fantastic papers lined up for you. There are no discussants in this session, so if you do have questions, please post them in the Q&A box at the bottom of your screens, and I will relay those to the presenters after their talks. So without further ado, let me hand over to the first speaker, who's Miguel Boucinha from the European Central Bank. Miguel, the virtual floor is yours.
Hello, thank you. Let me first of all thank David and Matthieu and the organizers in general for including this paper in the meeting, and also more generally just for kind of going ahead and finding an alternative to do the meeting in the current circumstances. Of course, would be much nicer to meet in person, but it's good to know that we can find alternatives and still move ahead. So let me, so this is a paper where we look into the role of banking supervision, how it interacts with monetary policy and with bank risk-taking. And we look at this with evidence from a collection of credit registers. So this is joint work with Carlo Altavilla and Frank Smets from the ECB, and with José-Luis Peydró from Imperial College. So of course the usual disclaimer applies that these are our own opinions from the authors and do not reflect the views of any of our organizations. So given that, let me go ahead and start with the presentation by giving you a preview of the main questions and results that we are going to tackle with the paper. So the first question on the role of banking supervision is whether having centralized supranational supervision change the risk-taking of banks compared to just having traditional local national supervision. And the second main question is how does this interact with monetary policy? So more concretely, does the interaction between bank supervision and monetary policy also affect bank risk-taking? And to give you, in a nutshell, the results, so the answer to the first question is yes, there is an impact, and the impact is that centralized supervision reduces lending to riskier borrowers, and it does so especially in countries that were more affected by the sovereign crisis, so let's say in weaker economies. And in terms of why this happens, what we see is that actually the effects are stronger for very large banks in absolute terms. This is what we are going to call a systemic hypothesis, but they are not stronger for banks that are large only relative to their country, which would be more consistent with what we will call a capture hypothesis. So on the second question, on the interaction with monetary policy, the answer is again yes, there is an interaction. And to be more concrete, what we see is that monetary policy easing tends to increase lending towards riskier firms. So this is no big news here, the standard risk-taking channel of monetary policy. But the news is that this increased risk-taking is can then be offset by centralized supervision. But importantly, here we are talking about, let's say, bad risk-taking. So the centralized supervision reduces kind of excessive risk-taking, but not the more productive and desirable risk-taking. So that said, let me just very briefly place the paper a bit in the literature. There are kind of three main contributions that we make. So the first trend of the literature that we contribute to is actually quite recent and growing. So there is a recent growing literature on bank supervision. And we contribute to this literature by looking at the importance of centralized and local supervision. Second, there is of course the literature on monetary policy and restating, which is of course more established. No, there are a large number of papers also going back now like 20 years looking into these issues. And here our contribution is really on the interaction between the monetary policy and the bank supervision. And the third contribution that we make is more related to external validity, because typically questions have been on banking have been answered using single credit register. So by now, credit register is kind of taken as the standard and important for identification. But the innovation that we do here is that by having credit registers for different countries, we can look into cross-country heterogeneity. So we can look at differences across country and have external validity, while at the same time keeping the important clean identification from the granular data. So that said, this is very briefly the outline of the presentation. So first of all, I will just quickly present the data, and then go through the results and reach the conclusions. So this slide is just to present to you the data set that we use. So this is, as I said, it's a data set that includes credit registers for a set of euro area countries. The frequency is half yearly, and the time period covered is from 2012 to 2017. And some important features of the data set is that we cover like different types of countries, so kind of stronger, more stable economies and weaker economies also that were more affected by recent crises. Importantly and crucially for our question, we covered the centralization of bank supervision. So in November 2014, of course, the ECB became the central supervisor, also crucially for some, but not all, the euro area banks, and also very importantly, not for all countries. So for the euro area countries, but not for European non-euro area countries. And importantly, our data set covers also some European non-euro area countries. So this is going to be important also to have kind of a placebo test on our results. The second thing that I would like to say on the data set is that, of course, we are going throughout the presentation, you will see that we are going to be exploiting the granularity of the data set to kind of sharpen the identification by using a very extensive set of fixed effects. So we are going to use firm bank fixed effects to control for non-random matching between banks and firms. So for instance, there's literature saying that good banks tend to be more matched with good firms, or it could simply be that there is a particular relationship between a bank and a firm that simply they are kind of closely connected, also in terms of brand values, whatever. And so for some reason, a bank is closer to a certain firm, and this is controlled for with the firm bank fixed effect. Then we use bank time fixed effects, control for all observed and unobserved heterogeneity at the bank level. And then we have two options in terms of controlling for firm heterogeneity, risk, and demand, which is that either we go for firm time or for sector time fixed effects. And here having the two alternatives is quite important, because obviously when we use firm time fixed effects, we are going to be restricting the sample to cover only the set of firms that have multiple bank relationships. And this is what the two maps here show, that obviously this is going to restrict our sample. So on the left-hand side, you see that the share of firms that have multiple bank relationships varies a lot across countries, but let's say it varies between 10 and 50% of the firms across countries. Whereas, of course, the firms with multiple multiple relationships are going to be bigger ones. So if we look at this in terms of share of lending, which is going to be more important for representativeness of the results, we see that then the coverage of firms with multiple relationships is much higher. So in terms of share of lending, it will go from closer to 50 to 90%. That said, we then move to the first question, which is then on the impact of supervision on risk taking, and just present to you our specification. So we are going to basically be doing regressions where the left-hand side variable is the volume of lending to a certain firm operating in a certain sector by a given bank at a given time period. We are going to have, of course, a set of fixed effects, as I said before. Then we are going to look at borrower quality, so at the risk of the firm. This is the PQ. And we are going to look at SUP. So SUP is a dummy variable identifying centralized supervision. So it is one if a bank is centrally supervised at periods T, so since 2014. And then our coefficient of interest is going to be on the interaction between firm risk and bank supervision. And the hypothesis that we are going to be testing is that once a bank becomes centrally supervised, does it provide less credit to riskier borrowers? So is centralized supervision more able to avoid excessive risk taking? And this is the first set of results. So the coefficient of interest is the interaction that you see in the second line of the table. And you see that, so the first and the fifth column of the table are the specifications where we control for sector time fixed effects. So we keep also firms with single bank relationships. And you see that indeed the coefficient is negative and significant. That's the first thing. So so centralized supervision does lead to less risk taking by banks. That is the first result of the table. The second one is that in non-stressed countries, so let's say in countries like Germany, Austria, and so on, the effect is smaller than in stressed countries, which are Portugal, Spain, and Italy. And the second thing that you see is that not only the effect is quantitatively smaller, so for a 1 standard deviation increase in credit quality, these coefficients mean that credit supply to the risky firm would decrease by close to 8% in stressed countries and 5% in the other countries. But you see also that the result is less robust in the non-stressed countries. So in column 6, you see that when we introduce the firm time fixed effect, so when we control for firm demand and risk at the firm level rather than sector level, we kill the effect. Now, the second thing that I would like to show you here is to kind of say, but you know, is this a good or bad thing, decreasing risk? Because of course, for a bank to lend to a riskier firm is not necessarily a bad thing. It could simply be that the bank is kind of breaching the liquidity of a firm that is in some kind of temporary trouble, but is actually a good firm. So what we do to check that is we look at the exposed outcome of the firms. That's what you see in columns 3, 4, 7, and 8, is what if instead of looking at the ex ante risk of the firm, we look at the exposed. So did the firm perform badly exposed still, or did it recover after receiving the loan? Was it just a firm with temporary troubles? And what we see is that basically the results stand. And this leads us to conclude that the result we see here is not really this kind of efficient funding of illiquid firms. It is rather, let's say, bad risk taking in the sense of lending to firms that are really non-viable. So in this sense, what we are saying is that the centralized supervision is reducing bad risk taking that actually should not be there. This these results on productivity, I'm going to skip in the interest of time, but just to say in one word, here what we see is kind of strengthening these results to ask also if bank supervision, by reducing risk-taking, reduces also lending to more productive firms. And we find that it doesn't. But I'll be very quick on this just to keep to the time. And I will instead just briefly talk about some robustness checks that we do. So the first kind of group of robustness checks is on the cross-section. So the banks that are centrally supervised are not, the selection of these banks is not independent of bank size. So of course, one thing that that you could wonder is whether we are really capturing the impact of supervision or just the impact of bank size. And in order to address this comment, what we do is we focus on banks that are really just around the threshold to become centrally supervised. So banks with similar size. And we also control for bank size also in interactions in addition to the level that is taken by the fixed effects. The second important robustness check is this external placebo of looking at the non-euro area EU countries. So these are countries that are still in the EU, but there was no centralization of bank supervision. So what we can do is we can introduce a dummy to check whether we would still get the result, assuming that centralized supervision was introduced in these countries, and see what happens. And we see that we do not get the result. So let's say we pass this placebo test. And the third robustness check is on the time series. So basically looking in more detail at whether it is really specifically when the centralized supervision is introduced that we see the impact on risk taking. And on this one, I show here a graph where you can see the result. Basically, the blue line is the coefficients that you would get by setting the start of bank supervision at different dates. And indeed, what you see is that you start to see the impact from the end of 2014 as expected, because this is when centralized supervision was introduced. So this gives us some comfort that we are getting the result we want, and not, let's say, the effect of some other change, because of course we know that many things happened after the financial crisis that could confound our results. So let me just very quickly then speak about then why we think this happens. And here we have two hypotheses. So one hypothesis is simply that systemically important banks, because they are so large, they have kind of direct and indirect spillovers to other countries. And so this creates an externality that the supranational supervisor internalizes, whereas the national one does not. So if this is true, we would expect the centralization of bank supervision to increase the risk sensitivity for very large banks. On the other hand, it could be that simply local supervisors are easier to capture by banks that are important for the country, because they are more susceptible, let's say, to revolving doors and lobbying and things like that. And if this is true, then we would expect the impact to be more significant for weaker banks, where capture would lead to a bigger distortion, and for relatively larger banks. So these are banks that are important for the country, but they are not necessarily systemically important in general. And so basically we do this by expanding the specification with some further interactions. And to show you the results, what you see here is that in black, so highlighted in the black rectangle, the triple interaction, you see that there are no stars. So basically this means that there is no evidence that that the centralized supervision acts more on the weaker banks. So let's say no big evidence for this capture hypothesis. But instead, when you look at the red rectangle, you see that you have consistently stars for the triple interaction, which means that centralized supervision reduces risk-taking more for very large banks. And this supports our systemic hypothesis. Now, of course, here what you could wonder is what are very big banks in absolute, and does this definition of the threshold matter? So what we show here is that basically for banks with total assets above 300 billions, we have this result. So that is what we consider very large in absolute. And second, in this table, basically the first lines just show the coefficients that were in the chart before, but importantly, in the last line, we look at the largest bank for each country. And this is important because for the largest bank in each country, we would expect that there would be the possibility of capture. This bank is obviously very important for the country, but on the other hand, it is not necessarily a very large bank for the euro area as a whole. So probably the systemic importance externality is not there. And indeed, again, we see non-significance here that supports our kind of narrative that what is happening here is not so much the capture, but more the systemic relevance of the bank. And finally, just to show the last result, it's running out of time, so I'll be quick here, is on the interaction between bank supervision and monetary policy, where we again just expand the same specification with interaction terms for bank supervision and monetary policy. And the hypothesis that we want to test is whether first, monetary policy easing leads to an increase in lending towards riskier firms, and second, whether centralized supervision then cancels this increased risk taking. And these are the results. So basically, the answer is yes. The monetary policy does increase risk taking, but supervision offsets this. And this is illustrated here more clearly in this chart, where you see that not only, let's say, that the centralized supervision has the opposite coefficient, but actually that also the size of this coefficient is enough to totally offset the increased risk taking due to the monetary policy easing. And this concludes the presentation. So I would just very quickly go again through the results. So we find that centralized supervision affects risk taking. So it reduces lending to riskier borrowers, especially in weaker countries, and that these effects are likely related to the systemic importance of the bank rather than to the capture of the local supervisor. And second, we find that while monetary policy easing leads to an increase in risk-taking, this is offset by centralized supervision, but centralized supervision does not offset the productive risk-taking, so let's say the lending to riskier firms. And this concludes my presentation. Thank you.
Wonderful. That was super interesting. Thank you, Miguel, and thanks for sticking to the time as well. Okay, so for those of you who have questions that you'd like to kind of raise, please post them in the Q&A box. See, there aren't any at the moment. I might just ask whether any of my fellow panelists would like to raise a question. I have some myself, but I'll ask you guys first.
Well, maybe I could try. I mean, banking assets are fairly concentrated, and your estimates are basically for the mean bank, right? You've shown, for instance, in Germany that it's 18% of the institutions, but I don't know, 80% of the assets in these two maps. Is that of concern? Should one look kind of at the Koch's distance across, say you take a baseline, your baseline specification, and look how, how the impact on the estimate is varying with bank size, for instance. The other question is then typically the kind of these GE counterfactual effects, right? Is one crowding risks to somewhere else? Because you might want to say, oh, this is a risk-taking channel, let's switch it off. Suppose the counterfactual is everybody's centrally supervised, or everybody's decentrally supervised. Yeah.
Great questions. Any more you'd like to, any of the panelists would like to raise before I ask Miguel to respond? I mean, I might just chuck in one myself, which is I'm kind of interested in probing this kind of idea of excessive risk taking that you raised as well. And it'd be kind of interesting to know things like, do banks provision more? Do they change their provisioning practices? Do they change the interest margins? They're charging new borrowers. Is there any evidence? Can you actually look at the risk weights that supervisors are enforcing? Say, do model approvals change or something like that when a bank becomes centrally supervised? Links to this idea as well of zombie lending, where you may not actually recognize, it may not show up as a bank lending to a firm that then fails in some sense, but it could still be an unprofitable thing. I guess you covered that with your productivity variable. Do you want to perhaps respond to those two, and we'll see if any more questions come in?
Yes, very good, thank you. So on the first question was on the role of the bank size and the concentration. So on this, just first to clarify that these shares that I showed in the maps apply to the firms with to the firms with multiple bank relationships. So this 80% of lending is the representativeness of the firms with multiple relationships. Actually, the coverage of the data set is bigger than that, and this we take in the specification with that have only the sector time fixed effects. But anyway, I think that the main point of the question, if I understood correctly, is simply that large banks can be different from small banks. And it would be interesting to kind of explore whether the results change for that. And indeed, this is something that we looked at, and we looked at it specifically and especially because the size again is important as it is related to our definition of the affected banks, because the banks that are centrally supervised are the bigger ones. So what we did in that regard was just kind of exclude different types of banks. No, so we do robustness where we kind of focus on banks that are of let's say medium size. They are big enough to be centrally supervised, but not like the huge GSIBs. And we find actually the results do not change much there. And the second thing is also in our definition of very large banks, we see that this threshold of 300 billion up is important. So that's where we start to see the systemic importance effect kicking in. On the general equilibrium effect, this is a very interesting question. It's also a very difficult one to answer, obviously, with these. Here we have a bit to go into the trade-offs. So with this credit register data, of course, we are very happy that we can kind of be clean on the identification and control very well for an observed effects and so on. But of course, it's then very difficult to have a picture about things like general equilibrium, feedback effects, and so on. So basically, the way how we try to tackle this is to have these specifications where we look a bit into the productivity of the firm. So we try to see whether we are the central supervision is hampering the lending to the more productive firms, and then we see whether also kind of our measure of risk is capturing kind of simply temporary problems of the firms, or really firms that are definitely in trouble, which links us more than to the bad risk taking, to things like closer to zombie lending and so on. Now, of course, to be clear and honest, one thing that we leave out as well are things like diversification effects, no? Because again, if we are looking at the risk of the firm, of course, if the portfolio as a whole becomes less risky because the firm independently, the firm is risky, but they are kind of negatively correlated, this is something that is very difficult for us to capture. So that is a caveat that we have to accept. And finally, then on the questions about also the concept of excessive and the reaction of the banks. So this is something where it's I think it's a very interesting comment, and it is something where I think we can try to expand more. So for now, what we see really is that with the fixed effects, we try to really focus on keeping every other difference in the bank except for this one constant. So that we know that that in principle, things like a bank having more capital or a bank having a stronger provisioning policy is not really driving or affecting our result, because we are carefully controlling for these things. Now, another question is, do the provisions or does the capital react? And here it's something that that we can try to look in deeper. So that's it's a very good comment, and that we can try to implement.
Great. Okay. I think we're out of time for that. So thank you very much. So let's move on to our second presenter. So Pauline Gandre from the University of Paris, Nanterre. Pauline, the floor is yours.
Okay, so good morning. Thank you for selecting our paper for this session. So the paper I'm going to present deals with the unintended consequences of the global reform of the OTC derivative market. And so it's a joint work with Mike Mariathasan, Ouarda Merrouche, and Stephen Ongena. So the global reform of the OTC derivatives market was launched in 2009 during the G20 meeting in Pittsburgh. And so it was a response to the crucial role that the OTC derivative market played during the global financial crisis. And it was a previously unregulated sector. So the G20 countries in Pittsburgh agreed on a global reform agenda for the OTC derivative market. And the main objectives of this agenda was to increase transparency and reduce systemic risk. So then it's a global reform agenda, but then obviously it has to be separately implemented in each of the national regulation by the distinct G20 participating governments. So this creates the potential for cross-country disparities in the timing of implementation of the reform. So this global reform agenda for the OTC derivatives market that was decided in Pittsburgh in 2009 includes 5 main regulatory blocks. So the first one is that all OTC derivatives transactions should be reported to centralized trade repositories. The second one is that OTC derivatives that are standard enough should be centrally cleared, and they should also be traded on exchanges or on electronic trading platforms. And then higher capital requirements and minimum standards for margin requirements should be imposed to all OTC derivative transactions that are non-centrally cleared, namely that are non-standard enough. So actually, we observe many delays and heterogeneity in the timing of the implementation of the reform across the distinct G20 countries. So regarding the US, they implemented early the reform in comparison with most other G20 countries. However, there is some specificity in the US regulation of the OTC derivative market, which is a regulatory loophole, which is actually the result of intense lobbying by US banks. And so this regulatory loophole is that US banks' foreign branches are subject to the US domestic regulation in what regards OTC derivatives, but US banks' foreign subsidiaries, which are completely separate legal entities, they are subject to the host country regulation and not to the US regulation. Hence, the reform presents several transaction costs for US banks because the reform implies collateral requirements and infrastructure costs. So the fact that there is this regulatory loophole in US regulation and in the context of important disparities in the timing of implementation of the reform in the distinct G20 jurisdiction, this opens room for US banks' cross-border regulatory arbitrage. So this means that US banks can try to avoid the costs associated with the early implementation of the reform in the US by shifting their OTC derivative activity in their foreign subsidiaries located in markets that are less regulated than the US markets. So in the literature, there is plenty of empirical evidence that banks practice cross-border regulatory arbitrage in several aspects. But in what regards specifically the OTC derivatives market reform, the focus of the literature was only on the direct consequences of the reform and not on the indirect and potentially unintended consequences of this reform. However, the OTC derivatives market is a global and liquid market, and so these characteristics make it prone to a cross-border regulatory arbitrage. And so given this gap in the literature, the research question that we raise in our paper is the following. So did US banks opportunely shift their OTC derivative activity in their foreign subsidiaries located in less regulated markets in response to the early implementation of the reform in the US? So to answer this question, we rely on previously unexploited data from the Fed, which provides information of securities holdings of US banks' foreign subsidiaries, and in particular on OTC derivatives contracts of US banks' foreign subsidiaries. So first, in our paper, we document the unequal progress in the timing of adoption of the reform across the distinct G20 jurisdiction. And so to do so, we relied on Financial Stability Board reports that are published on a regular basis. And this enabled us to construct a time series of national indices of reform progress for each of the 5 blocks of the reform that I presented before. And we can construct these indices for 18 countries plus the European Union. And so each index ranges from 0 to 4, and 4 means that this block of the reform is fully implemented. And then we also construct a global regulatory index to summarize the scope of the reform. And so this global regulatory index equals the number of the 5 regulatory blocks for which the reform is fully adopted and implemented. So the table here presents the value of these distinct reform progress indices at the end of the year 2016. And so what we see from this table is that there is substantial heterogeneity across jurisdiction in the timing of adoption of the reform. And so we are currently updating the data of the paper, but in 2020, there is still a lot of heterogeneity in this timing of implementation of the reform. And there are still many delays in the reform. So many countries have still not implemented this reform more than 10 years after the G20 meeting in Pittsburgh. So what we see in the table is that at the end of 2016, there was only 1 country that had implemented the 5 blocks of the reform, and this is Japan. And regarding the United States, they had implemented 4 of the 5 blocks, and for each of the 4 blocks that they had implemented, they were among the first countries to implement this regulatory block. And if we look at the European Union, it had implemented 3 blocks out of 5. And there are also some countries that had implemented only 1 block of the reform at the end of 2016, for instance, Argentina or South Korea. So then, at the same time, the US implemented early this reform, we observe a striking shift abroad in interest rate swap position of US banks' foreign subsidiaries, and between 2010 and 2015. And so 2010 is prior to the implementation of the reform in the US, and 2015 is after the implementation of the reform in the US. And so we see that this shift in interest rate swap position of US banks toward their foreign subsidiaries is particularly striking for Citigroup here between 2010 and 2015. And so we can document a bit more specifically this geographic reallocation in interest rate swap position of US banks through their foreign subsidiaries. So the map here represents the change in the share of the total US banks interest rate swap activity operated in each country between 2010 and 2015. So the darker the blue, the bigger the increase in the share between 2010 and 2015. So what we see from the map is that there has been a strong decrease in the share of total US banks interest rate swap activity operated under the US regulation. So this is consistent with the previous chart. And we also see that there has been a strong increase in share in many countries worldwide. So there has been a strong increase in the UK, in Japan, in Australia, but also in countries such as Mexico, Brazil, Hong Kong, China, and South Korea. So now, to test whether this geographic reallocation reflects cross-border regulatory arbitrage, we face some challenges for identifying this cross-border regulatory arbitrage. So the first one is the concern that the host country could actually actively delay the reform to attract more US dealers' derivative activity. The second, so basically this would be a reverse causality concern. So the second concern is that there could be some unobserved country characteristics that could affect both the progress of the reform and the willingness of US banks to trade in a given country. So endogeneity issue concerns. So to address these challenges, we take a number of steps. So first, we show that the determinants of reform progress are primarily structural, which partly alleviates reverse causality concerns. Then we instrument reform progress, and then we proceed to several robustness checks that I will present afterwards. So in a first step, we analyze the determinants of reform progress by estimating a multi-level logit model with random effects, which is designed for repeated events. So our dependent variable here is the log odd ratios, where the probability P here represents the probability of progress in the implementation of the reform. So it's an increase in the regulatory index, in one of the regulatory indices that I presented before. And we control for a cumulative duration since the last progress in reform, since we have some kind of trend in the data. And we also add several control variables that we separate into cyclical variables and structural variables. And of course, we also control for an observed heterogeneity across the distinct G20 countries. So first, we estimate a very simple baseline specification where the only cyclical variable that we include is GDP growth, and the only structural variable that we include is log GDP per capita. And of course, we have to control for a cumulative duration since last reform progress. And so what we see from this first results is that log GDP per capita is more robust to explain reform progress and has a stronger impact on reform progress in comparison with GDP growth. And so this first suggests that structural factors matter more to explain reform progress in comparison with cyclical factors. And then we include several additional determinants of reform progress that we include one at a time. because they are actually very correlated among themselves. So we separate them once again between secular structural factors and cyclical factors. And so what we get from these results is that reform progress is positively associated with government effectiveness in a given country and with liquidity and depth of the local OTC derivative market that we proxy with log turnover in the OTC derivative market. And so these results actually suggest that reform progress responds to sluggish structural variables, which partly alleviates concern of reverse causality between reform progress and the location of US banks' interest rate swap activity. So then, in a second step, we proceed to test for our main assumption, which is the assumption that US banks practice cross-border regulatory arbitrage in the OTC derivative market. So here, our dependent variable is the share of given US banks' interest rate swap activity in a given country in a given quarter. So we have three-dimensional panel. And so we have here our main variable of interest, which is one of our reform progress index. And we control for a local market condition that could affect US banks' interest rate swap activity location. So here are our benchmark results. So we see that in our most parsimonious specification here, where we include only the global regulatory index and bank and quarter fixed effect, we find a negative relation between reform progress in a given country and the share of US banks' interest rate swap activity in this country operated through US banks' foreign subsidiaries. And we see that this negative relation is actually robust to the inclusion of several control variables and also to the inclusion of country fixed effects. So then, to investigate the differences between each block of the reform, we include in our estimation the index, the reform index for each of the regulatory blocks. And so what we see here is that the central clearing block seems to be the most relevant to understand the location of US banks' interest rate swap activity, because it has the stronger effect and the most robust effect across specification. And we see that there is a negative relation between reform progress in the central clearing regulatory block in a given country and the US banks' interest swap activity operated in this country through foreign subsidiaries. And so this result is actually in line with intuition, because central clearing is likely to be the costless block of the reform for banks, because it implies capital requirements, margin requirements, and also infrastructure costs. So then, to alleviate endogeneity concerns in this baseline estimation, we take a number of steps. So first, we include interaction effects between reform progress in a given country and enforcement of the US regulation in the US. And so this enables us to compare our effects before and after the implementation of the costless blocks of the reform in the US. Then in a second step, we instrument reform progress with measures of the destination country political and regulatory independence. So we rely on instruments that are widely used in the cross-border regulatory arbitrage literature. So namely, we introduce a variable which is the fraction of years since 1776 a country has been politically independent. And we also include a dummy that indicates whether the central bank shares the supervisory power over national banks, or whether it is the sole supervisor of national banks. And the rationale behind this choice of instrument is that there are structural factors that are unlikely to be affected by US banks' interest rate swap activity, but that are likely to affect reform progress. Then we ran placebo regression on foreign exchange swap position because foreign exchange swaps were not concerned by the reform to the same extent as the interest rate swaps. In particular, they were not concerned by the central clearing mandatory requirement. And finally, we also include interaction effects between reform progress and several measures of market and institutional quality to check whether there are some mitigating factors of regulatory arbitrage or not. So here are the results of our robustness checks. So first, we include interaction effects between the global regulatory index here and enforcement of several blocks of the reform in the US. And so what we see is that the effect of reform progress on the location of US banks' interest swap activity is bigger after enforcement of the central clearing block in the US, which is consistent with the previous result that we had on the role of the central clearing block. Then we see that the negative relation that we found in our baseline specification between reform progress and the location of interest swap activity of US banks' foreign subsidiaries in a given country holds in the 2 SLS procedure. And finally, in the placebo regression on foreign exchange swaps, we cannot find a significant relation between reform progress in a given country and the location of US banks' foreign subsidiaries' foreign exchange swap activity in this country. And so this is consistent with the idea that foreign exchange swaps are not concerned by the reform to the same extent than interest rate swap position. And then finally, we include several interaction effects between the global regulatory index and measures of market and institutional quality, so namely rule of law, government effectiveness, and log turnover on the local OTC derivative market. And we find that liquidity on the OTC derivative market and government effectiveness in a given country play as mitigating factors of cross-border regulatory arbitrage, so they curb regulatory arbitrage. So finally, to conclude, what we document in our paper is the existence of delays and cross-country heterogeneity in the adoption of the OTC derivatives market reform. And we show that these cross-country disparities are mainly driven by structural factors. Then we show that US banks appear to have taken advantage of these differences by shifting their interest rate swap activity to their foreign subsidiaries located in less regulated markets. And we show that these findings seem to be driven by the blocks of the reform that are costliest for banks, namely central clearing. And so our paper provides evidence of the unintended consequences of financial regulation as long as there is no international coordination regarding the timing of adoption of the reform. So we show that financial risk moves around and goes to places where it is not efficiently addressed, and therefore this raises important concern for global systemic risk management. Thank you for your attention, and let me know if you have questions or comments.
Pauline, thank you. That was a superb presentation and bang on time as well. So we do have a couple of minutes for questions. I'll again kind of encourage our attendees to post questions in the Q&A box. First of all, any of my panelists, is there any questions you'd like to raise and ask Pauline? Perhaps while you're thinking, I'll ask one myself. It was kind of a suggestion, which you may have done, but I'll raise it anyway. So I wonder if you could compare the reform progress indices you have for OTC derivatives with reform progress in other areas of the post-crisis package, Basel III, too big to fail regulation, resolution. It'd be interesting to know how well other kind of laggards in OTC reform, also the laggards in other areas, that would kind of add weight, I think, to your kind of structural hypothesis. That was one idea. Are there any other questions or comments from panelists? In that case, press.
Okay, so should I answer your question? Actually, yes, I think we could include interaction effects to control for the effects of additional regulation, because there has been a lot of different kind of financial regulation after the global financial crisis. Actually, we didn't do that yet, but I think, yes, we could control for this by including interaction effect with enforcement of distinct kinds of regulation in the US. However, I think that they wouldn't really be significant, because when we do the regression on foreign exchange swaps, as I showed, the placebo regression, there is no significant relation between reform progress and the location of US bank foreign exchange swap activity. So I think this is really this regulation, this specific regulation on the OTC derivative market that drives our results and that drives the shift abroad in US interest rate swap activity. But I think, yes, this is worth checking it anyway. So,
yeah.
So, yeah,
particularly with this endogeneity idea that some countries may be acting, implementing the reform slowly, deliberately to attract.
Yeah.
If they're kind of slow with everything else, that would cast doubt on.
Yeah. So I think we should check anyway, and I think we can include that very easily with interaction effects. Thank you.
Well, thanks for a really fantastic presentation. So our next speaker is Christoffer Koch from the Dallas Fed. So Christoffer, the floor is yours.
So, first of all, thanks for having us on the panel. So this is a bit of a party pooper paper, as I would call it. So there's a lot of papers about that tell us about capital buffers, how good they are, they estimate elasticities. And this paper sheds a bit of a skeptical light on some of that, or the reach of that. So what we are going to ask is, does financial regulation influence bankers' capital choices during asset market booms? And are countercyclical capital buffers of the magnitude, suggested by the BIS and implemented by, the Fed with 2.5 percentage points, are they a panacea for anything that could happen to economies? If you look down on these two charts, you see basically the asset pricing booms of the 1920s and of the 2000s. In the 2000s, we've included the housing market. And with that, you see these big crises, the Great Depression on the one hand, and the Great Financial Crisis on the other. And what we are going to do is we're going to compare bank capital choices in the United States across these two periods, arguing that they're very different institutional frameworks, and see how that shapes their capital choices. So, and these are the two questions, and here are the two answers. The answers is institutions definitely shape capital choices, and with regards to countercyclical capital buffers, the answer is really that there's at least some mitigating caution warranted. So what we do is we compare the capital choices of large and small banks, so systemically important banks and small banks, during both booms preceding the Great Depression and the Great Financial Crisis, with and without these modern institutions, which we subsume under the name too big to fail. And if you take anything home from this paper, it should be these type of graphs. So on the left-hand side, you see capital ratios of historical banks during the 1920s. And on the right-hand side, you can see capital choices, in this case, tier 1, but it doesn't matter. I'll show you later. No matter which capital measure you look at, you'll see the same outcome. So the take-home message here really is that the largest banks, in particular in New York City, massively increased their capital holdings prior to the Great Depression, you see a rather flat but still increasing capital ratio in other reserve cities, for instance, Chicago. Whereas in the 2000s, if you split banks by size and you say, you know, let's take the biggest banks with 250 billion and above, it's essentially flat. And ironically good though, these capital buffers moved up after the crisis. But, you know, you see these typical stylized facts. Smaller banks have larger capital holdings. But really, if you look at the dynamics of capital, it's essentially flat. So that's a take-home message. You know, now you can switch off. So let me, rather than talking about like the literature, I give you a few quotes from famous papers. And we've seen, you know, Faria-Castro's paper, a structure macro paper here, and, you know, one of the most famous micro empirical papers, you know, by Jimenez et al. So what do they say? So these macro models, you know, and David has some too, right, which are little smaller models, like game type of models. So Faria-Castro from the St. Louis Fed has a nice model on countercyclical, a quantitative macro model, and he writes that CCYBs of the 2.5 range, which is the current Federal Reserve's framework, could have greatly mitigated the financial panic of 2008 for cumulative gain of, you know, about 1/3 of aggregate consumption, right? It relies a little on subgame perfection. So actually in his counterfactuals, the crisis doesn't happen, you know, to start with. And then there's kind of this empirical literature, which kind of looks at these elasticities, right? A 1%, you know, they look at discontinuities and jumps, if you like, and have these, the type of data sets that we talked about in the first session of this panel. And they come up with these elasticities, right? I mean, you know, 1 percentage point higher capital means, you know, 9 percentage points greater credit supply, 6 percentage points higher inflation. So you have kind of these elasticities, and the survival probability also increases. So basically the modern literature says, you know, it looks a bit, you know, that these micro effects are nice, and typical structure models tell us that countercyclical capital buffers are great. And, you know, yeah, so what we are going to do is we're going to think about the institutions, and in particular the institutions limiting bankers' liability that induce leverage. So there's papers out there that look at, you know, liquidity regulation, capital regulation, and their welfare consequences for, you know, representative consumers, bankers, and so on and so forth. And we're thinking of how these changing institutions have, you know, have led to potential distortions. I mean, what we're looking at is really an issue of moral hazard. Everybody says, you know, everybody talks about the weather, but nobody does anything about it. And here we're saying everybody talks about moral hazard, but we actually try and show a bit of what its effects are. So these distortions are trying to be elevated by regulatory constraints. For instance, today we have somewhat binding capital requirements, or optimal pricing of the risks. We have deposit insurance these days that comes with an FDIC fee for years. Or you could potentially offset these distortions by getting back to what would be termed a return to the regime of market discipline, although it's not, it's really enforceability of liability. So what are the institutions that we're talking about? As I said, today, if you own bank stock, you're no longer liable. If the bank goes bust, you lose all you put in. So limited liability as an institution that got kind of strengthened, in particular in the 1930s via institutions I talk about later. The issue of lender of last resort, you know, for instance, the Federal Reserve, the instance of regulatory forbearance and forgiving resolution procedures, and with 1935, the establishment of the FDIC. So I show you a graph later where we kind of show initial instances of banks being bailed out in a timeline. But this potentially preferential treatment of larger banks might lead to this phenomenon termed too big to fail. So what have people done? I've cited, you know, you can't review the whole literature, but I've cited, you know, these two papers, one on the elasticities by Jimenez et al., the structure paper by Faria. Dave himself has papers on this with Andy Holden and Ben Nelson. There's a whole plethora of existing studies out there that we try and speak to and potentially be the party pooper to. So what's the problem? We can't randomly assign institutions. We can't say, oh, here's a counterfactual universe where we suddenly introduce, you know, different deposit insurance schemes or in particular different liability schemes for directors and officers of commercial banks. There is no random assignment, there is no parallel universe, and it's hard to come up with modern panel data. I mean, these beautiful panel data that we saw in the first paper, for instance, that's not available for these different type of institutions. So in this institution, obviously, are endogenous even to past crisis, right? For instance, if you study a bit of economic history, typically a US state will have better regulation after a financial crisis. These treatments are ubiquitous, simultaneous, so it's very difficult to find kind of a perfect experiment here. So what we try and get at was to get to banks prior to the advent of these modern institutions like limited liability, but still find an environment that resembles those of the environment you know, that was prevalent in the 2000s prior to the great financial crisis, and then really compare the capital choices of a similar set of banks at the time. So here we're really comparing the roaring 20s to the roaring noughties, if you like. Like we had huge inventions that pushed mankind forward in the 20s. I'm not sure how useful the iPhone is, but you see a lot of these landmark inventions, the phone versus the smartphone, you know, light movie theaters versus these animated Pixar type of movies, the invention of mass radio, Netflix, you know, modern medicine and DNA. So there's a parallel to these kind of revolutionary inventions there. But you also see that in asset prices. So you have kind of the big success of the Fed at its founding, founded in the wake of the 1907 crisis. Similarly, the founding, the apparent success of inflation targeting and the Great Moderation. So we had quite a good and quiet time in the 1990s. And then you have these asset price booms, in this case illustrated by both the housing prices and the Dow Jones Industrial Index. So we had these unprecedented asset price booms that then led to a collapse in 2009 and 2008. So we would say that these institutions are different, but the environment is somewhat comparable. So the big difference in the 1920s compared to the 2000s was that the institutions were substantially different. What you see in this table here is every bank that failed with deposits over 30 million, with the exception of the Bank of Tennessee down there, that was kind of the center of this Cadwell financial network. So this is all the banks that got either into voluntary liquidation or that went into mergers under duress. It's not so important what these individual banks are and what they did. You can read up on this on the paper. There's like really fun anecdotes in the paper about how directors and officers of these got sued. What I would point out is the last three columns to the right, which basically tells you that literally all the big banks that failed in the 30s got both a criminal suit and a civil suit treatment. And that even turned to the assets of the family. So it's not like, you know, these big fools, you bet a lot and, you know, you come out of this and you're multimillionaire despite ruining half the economy. So bank executives really were held liable in the 1930s. And I really encourage you, there's like fun anecdotes there. You know, for instance, Bernard Marcus of the Bank of the United States in New York City, the first one there. I mean, he ended up 1.5 years in prison, and in the end, he worked on parole in 1937 in a pajama factory. So this is really shows you that the kind of punishment that was induced. And it was not just the fact that you had double liability, so that if you hold a bank stock, you were liable not just for the initial capital you put in, but also for the very same sum. People could also go after you in civil suits. So essentially, if you write down these models with limited liability, it's not just that there's a negative, but it could potentially be, you know, up to zero of your whole assets as a director, and that changes incentives for people to pro-cyclically provision. So here's kind of in gray, you see a timeline. In gray, you see the two time periods where we compare bank capital choices. On the bottom, you see what we would call precedents or potentially of too big to fail. For instance, Franklin National, Penn Square, Continental Illinois, that were kind of bailed out, long-term capital management, where the Fed arranged a collective bailout by the biggest investment banks. And then, of course, it's not a bailout, but you know, the failure of Lehman Brothers. And we have a whole set of institutional changes. I would just, you know, legislative changes that really changed the nature of liability. I would highlight here in particular the Banking Act and the founding of the FDIC, for instance, because you get insured deposits suddenly, which, you know, might lead to some risk shifting, if you like, if somebody provides you with insurance for these. I should have put in the Bankruptcy Reform Act of 1938 too, because after 1938 it was far easier to declare bankruptcy. Bankruptcy laws before 1938 were incredibly harsh in the US. Like, you could literally go from billionaire to beggar due to very harsh bankruptcy laws. So, but that's outside of the banking system. Here I just listed the respective acts in the banking system. But what impinges on the incentives is really a big change. So we can't capture each one individually, but we're saying there was an asset price boom here, there was an asset price boom there, and let's compare over the business cycle how bank capital evolved. Okay, so speaking about our data, we get the modern data is fairly trivial, publicly available to anyone who can download things from the FFEIC, from the consolidated reports of condition and income, the so-called call reports. The call reports are called that because they were literally called, and in those days, quasi-randomly sometimes in historical periods. So it wasn't always the end of the quarter, but it could have been, in random weeks to ensure that you don't just do window dressing at the end of the quarter. So we're using these call type of reports from the New York State Superintendent and from the OCC for the national banks. Okay. So here's kind of the take-home message. You compare the samples and you compare state and national banks. So what you see here there's state charters, there's national charters, state and national charters, and you can really compare the mean of capitalization for the largest decile, smallest decile, the 10 largest banks, and so on and so forth. The key point to take home here is that during the boom, the 10 largest banks in the US raised their capital by about 2.5 percentage points. The largest decile by 2.2 percentage points. The smallest decile remained essentially flat. Whereas if you look at the modern day era, you see essentially flat capital structures during the boom. So that's, the take-home message that you've already seen in the graphs, but we can also try and get a bit, you could argue these are just like randomly picked dates. So what we'd say is, let's look at 6 different measures of the business cycle and transpose calendar time into kind of a unit time interval. One reason for that is, for instance, that the call reports in the historical past aren't as regular. They aren't just quarter end, but they are randomly called. Whereas today, call reports, bank regulatory reports are really at the end of each quarter. So what we're going to do here is we're going to say, look, there are 6 business cycles that, in part, all of them feed into the NBR. There's more discretionary NBR business cycle declaration. So we take the NBR business cycle, we take the short-term interest rate, peak to trough, we take consumption, the Dow Jones Industrial Average, the volume of payments, or total payroll. So, you can, and we make them comparable, right? We say there's an NBR business cycle here, there's an NBR business cycle in the 2000s, in the modern era, there's a short-term interest rate cycle then and now, similarly for consumption. And what we're going to do is, as you can see here, we're going to transform a calendar time into a unit interval so that you can say, no matter which business cycle you look at, what's the change in capital that you observe. Okay, so this is basically a transformation from calendar time into unit interval, modern and historic, and that enables a direct statistical comparison between the historical and the modern era. Then we denote these SIFIs, right? There's various definitions. If you look at the paper, this is robust to almost any SIFI definition. And then how does the cycle is this unit interval, right, for these 6 cycles. How does the capital choice vary between the modern and the historic data? So let's look at the historic one first. So the SIFIs just unconditionally, SIFIs raise their capital here statistically compared, first of all, SIFIs do have a lower, though not statistically lower capital levels, whereas in the modern era, they do have a significantly lower capital ratio. They raise their capital ratio throughout the cycle by, about 3-4 percentage points. In the modern era, it's hardly moved, in particular once you include bank level fixed effects. Now, what you actually want to do in this experiment is you really want to compare the historical versus the modern response throughout the cycle. So how much does capital go up in the historical period as compared to the modern period? And you can do that for various measures of equity. There's like the Tier 1 total capital ratio, the Tier 1 leverage ratio, or the pure equity ratio. It doesn't matter which cycle you look at of these 6 cycles that I described. It doesn't matter which capital ratio you compare to these historical capital ratios. What you end up is a significant change of between, say, 2.5%, which actually nicely matches the statement from the initial paper from the structure macro model, up to 5% percentage points, if you like, right? So that's the key message. Institutions appear to matter. This limited liability, deposit insurance, this amalgamum of different institutions that really gives you liability for these actions and don't allow you to merely gamble, really impact capital choices. And you can kind of run through a whole bunch of robustness tests on this, business cycles, sample decomposition. I mean, I can give you, you can think about like measures of centrality. You can look at different measures of equity. You can look at different size cutoffs. You can look at different shocks, just Fed banks, state banks, only in New York, out of New York. The same is true for the 2000s. Like there's a myriad of robustness checks that you could try. So you hardly, in almost all of them, you see significant upticks in the historical capital, and you hardly, you never see anything in the modern banks. So this is where we get to, in some sense, to the policy implication, or a bit of a skepticism. This is kind of the party pooper element of this paper. If you look at this table here, this table shows you New York banks, in particular the 19 SIFIs that we have here, and their state by 1932, basically after the banking panics. So what you see for the whole of the United States, and that's, that's well known, that, about of the 24,000 banks, 5,000 died and 5,000 were kind of forced to merge. So really the banking system took a severe hit with a massive decline in the number of independent banks. If, however, you look at the core banks, none of them failed, 4 of them merged, but really the core of the financial system, and if that's the objective, to preserve the core of the financial system, then we are good. A key message, though, that comes home from our paper is to think, well, is it a panacea? Well, it saves the core of the financial system. And by the way, these countercyclical capital buffers, they were never called that way. Financial regulation at the time was really defined in terms of like city size. It was very uniform across, it was really only based on the city size, but there was kind of regulatory guidance by the New York Fed. I see a chat box coming up. Yeah, so this gets us to our conclusion here. These countercyclical capital buffers that, with the coordination of Basel, have been adopted worldwide recently. They've been very widely held as like, oh, it's potentially a panacea for a lot of them. We argue that similar policies and this kind of regulatory guidance from the New York Fed operated during the Great Depression. So it was regulatory guidance plus these massively different incentives. And these Depression era CCYB saved the core of the financial system, but little else. The Great Depression still happened. We still saw the biggest economic contraction on record in modern times. So the implications are really that CCYBs can help control financial crisis. They might not be a silver bullet, and I think that's the important thing. And capital regulation may need to be universal. We're mostly focusing on these kind of SIFIs, but as you could see, it's a lot of smaller institutions. And for modern times, these smaller institutions might stand in for other things. They might stand in for the non-financial corporate sector, the household sector, fintech, or whatever you might think. And the other take-home message here is potentially that this exposed liability that we really list with anecdotes in the paper, and with historical tables might be an alternative, effective way of generating these CCYBs. Yeah, so that concludes the paper 1 minute earlier than expected. Yeah.
Christoffer, thank you very much. That was an extremely clear and thought-provoking presentation. I'll kind of once again encourage attendees to post any questions they have. First of all, my fellow panelists, are any comments or questions you'd like to pass on to Christoffer?
This is Miguel here. Could I have a question?
Please go ahead.
Okay. No, first of all, I really thank you for the presentation. I found it really very, very interesting. This and it really shows that you can go far back in history and find and still find lessons very relevant for things that with a bit less perspective we think that are new. So it's really very interesting. But the question I would like to ask you is more on the interpretation of the results. So in a way, also the title of the paper and the way how you present it is a bit cautionary on the role of the countercyclical buffer. But my question is, isn't that a bit by construction? So because first of all, you are comparing to a period before a crisis, so you know, given the way how you select the period, we know that there would be a crisis afterwards, so it would be difficult to find something different. And in a way, it could be that in that sense, maybe you were asking too much of the buffer. And the second thing is whether, I mean, if you could expand also a bit more on the interpretation of it helping more the big banks, because in principle, you know, it's about creating a capital buffer for all banks. Now we do know that big banks normally are closer to the capital requirements. So is that the reason, or is there something else that you would like to point out?
Great question. Any more?
David, I come to you.
Oh, sorry.
Oh,
Can you hear me now? Yeah.
Yeah.
Any other questions from panelists or the audience? I might ask one myself. I think actually that's, an interesting question about that Miguel just raised about, you know, are there other episodes that didn't end up in the Great Depression that you could also look at to, you know, explore whether capital behaved in this way in the kind of pre-regulation era, like before the 1907 crisis, for instance. But my question was going to be around, it'd be interesting to know whether there's like anecdotal evidence about that you found about why banks found themselves raising capital over this period. Was it kind of market pressure? Was it concerns about risk building up in the system? Is there anything you can kind of tease out about the determinants of that capital raising?
Actually, there's the New York Fed has archives. I mean, I would put this as regulatory guidance in a sense. So the Fed kind of came out of these clearinghouses. In fact, I have a paper which we haven't written up, but we have evidence from the 19th century, for instance, where banks were lending to their own directors, and these guys repaid loans to themselves, which kind of changes the net leverage ratio. So there's evidence. So the New York Fed, at least, there was in part, this was coming from this kind of clearinghouse condition, but I think my co-author Gary can say a lot more to that. Gary, do you want to chime in?
Yeah, so I can answer, and it says Chris because I used his link, but
yeah, multiple personalities here.
Exactly.
Yeah, so I can talk about answer David's question, and then Miguel. So for David's question, it pretty clearly that the regulations are designed to create a set of incentives which are going to pressure the banks to raise capital. Part of the pressure is coming through the market, and part of the pressure is this threat that if you get into trouble, you're on your own, and we're going to come after you. So in this paper, we document like the pressure that's put on these bankers ex post, because we went to all the bank failures and we documented like the civil suits and the criminal suits. we have a previous paper where we looked at the interactions between these banks in New York and the New York Fed, where they ask in 28, 29, and then 30, 31, the New York Fed, are you going to help us out if we get into trouble? And the president, they used to have a weekly lunch of all the big bankers in New York and the New York Fed on Wednesday. And they kept the president of the New York Fed kept a diary of the discussions now in Columbia University Library. So we read that. And so he talks about the bankers asking them, are we going to get help? And the New York Fed says, no, if you get into solvency problems, you're on your own, right? We're not going to help you. And then in this paper, I have a quote from the head of the Reconstruction Finance Corporation, which is set up in the Depression as this sort of alternative lender, when he talks about the institutions we look at, and he says, they work great. They got the big banks to hold all this extra capital, which is what they were supposed to do. So they've set up a regulatory system to try to induce the big bank to hold lots of capital and to raise capital in the boom. In booms, because they're threatening them, if you go under, we're gonna come after you. You're gonna lose your houses, you're gonna lose your jobs, right? We're taking all the money we can get from you. That the head of the largest bank that failed in the Great Depression, this bank in the United States, he spends a year and a half at hard labor in the state's maximum security penitentiary. And they sue his family, they go after his wife to claw back. You know, they say, you've got money from your husband, they claw back all her assets and they put her on a payment plan for the rest of her life, right? This is pretty harsh. And what was the crime he did? His company injected capital in their subsidiary. And they claimed that the stock price that they carried this on the internal transaction was not fully reflective of the value of the subsidiary, right? It's like a minor technical infraction. Actually, what they did would be legal today. But and even when they tried to get a pardon, the governor, who was Lehman, the brother of the head of Lehman Brothers, said, "Yeah, it's a technical infraction. I'm not sure it's a crime, but we can't pardon you." Right? People have demanded your head. So this is the pressure that's driving the banks to accumulate. If you look back, now I'm going to seg into Miguel's question. If you look back to other crises, you see the big banks, right? So and you could go back from 29 to 1907, right? Another big crisis. And you could look at other booms, like there's a boom in asset prices in World War I. In all these booms before the Great Depression, you do see the big banks accumulating a lot of capital. Right? So that's a feature of the pre-modern institutions, is that the big banks are incentivized to build capital during booms. And the big banks had generally been pretty safe, right? And actually, if you know the big banks in the US, right, got JP Morgan Chase, you got Citibank, right? These banks were formed in the US around the time of the Civil War. And they've survived the last century and a half. And one reason is, right, they used to have a lot of capital and keep lots of capital on hand, so they survived all these crises. But the periphery of the financial system was always getting slammed in these panics. So I guess that we could do something like what Miguel said, is could we look at the earlier crises, and maybe we should add that, is to go back in time and add more about that. It's just difficult because we got to get lots more data and work to make the comparisons more clear, you know. And
yeah. Thank you. That was a brilliant presentation and a really useful response as well. So we better move on in the interests of time to our last speakers. So we've got Andrei Zlate. Is it Zlate or Zlate? I should have asked you that before.
Oh, it works both ways.
Both ways.
Andrei Zlate would.
So Andrei, the floor is yours. We've got until, I think it's until 1, but we started a little bit late, so we can finish a couple of minutes late too.
So great. So look, I'm very, very glad to be here. Thank you, David and Matthieu, for including our paper in the session. So I am Andrei Zlate from the Federal Reserve Board, and this is a paper co-authored with my colleagues from the Boston Fed. It's a paper about Rich for Yield by U.S. public pension funds. My co-author Matt Pritzker is also online, so I would say, Matt, please feel free to chime in at any time as I go through the slides. So, and everybody else, please ask questions at any time. First of all, what we have in mind with this paper is to study the Rich for Yield behavior of the, and can you see my, I'm sorry, before I start, can you see my video as well? I'm having a hard time, wait.
I can see you fine.
Okay, great. So the slides are the most important anyways. So in this paper, we study the Rich for Yield behavior of these financial entities, the US state and local public pension funds. We are specifically going to develop a new approach to measure the risk in the asset portfolios. And importantly, this method that we develop applies not just to public pension funds, but to financial entities in general. So we're going to measure the risk in the pension funds asset portfolios. We're going to relate the risk in asset portfolios to drivers, and the drivers we're going to focus on are the low risk-free rates we've seen in recent years, the low funding ratios of our public pension funds. I'll explain a bit what that means. And the weak public finances of the local state and of the state and local governments, right? So measure risk related to three drivers. And finally, we're going to examine implications of this Rich for Yield behavior for the state and local finances. And let me give just a teeny, a bit of primer on the US public pension funds. They are fertile ground for measuring Rich for Yield for a number of reasons. So first, they offer defined benefit pension schemes, meaning the liabilities are not related to contributions necessarily, and they are going to be risk-free. One consequence of that is that these public pension funds are underfunded, so the balance sheets do not balance. The assets are going to be less than the present value of the future benefits, which are the liabilities of the public pension funds. So this underfunding is a characteristic of the defined benefit public pension funds. It will be one of the drivers of Rich for Yield. At the same time, since this is a sessional regulation, loose regulation is a matter that reflected in many aspects of the public pension funds. It's reflected in the riskiness of the, so they are loosely regulated by the local government, state and local, by the state and local governments. In a decentralized fashion. So the loose regulation surfaces in many ways. It affects it's reflected in the riskiness of the asset portfolios. It is reflected in this underfunding feature of the funds, where the uncovered, the portion of liabilities uncovered by assets is guaranteed by the state and local governments. That regulate these funds in the first place. And finally, the loose regulation surfaces in the way of accounting standards that the funds use to compute the present value of the future liabilities, and this oftentimes results in an undervaluation of the liabilities, which masks the true underfunding, the true extent of underfunding. And as I said, the state and local governments, they sponsor the funds in a sense that they guarantee the liabilities. If the liabilities are not covered by assets, the tax revenue could be an alternative. Okay, so three main contributions. There are three main contributions to make in this paper. One is that we propose a model to interpret the channels of Rich for Yield. The second contribution, and very important, and importantly, we develop a new econometric approach to measure risk in pension funds asset portfolios. And third, we are going to measure the empirical relationship between risk, the way we measure it, and its drivers. Great. So that said, again, just to very quickly illustrate the three drivers of risk for yield that I've mentioned. So the low yields on safe assets, depicted here in the upper right chart by the green line, have come down a lot in recent years, whereas the average target return that the funds, the pension funds target, has remained stubbornly high. So this widening gap between the returns that the funds target and the low risk-free rate is a driver, has incentivized risk for yield. Second, as I said, most public pension funds are underfunded. So this is shown here in the bottom right chart by the blue line. The funding ratio of assets to the present value of liabilities, the way the funds compute the present value of liabilities, we see that the portion of liabilities covered by assets has been declining over time. And like I mentioned, the liabilities are undervalued by the accounting standards used by the funds. When we rediscount those liabilities using a generally accepted method proposed by Rauch, the true extent of underfunding appears even more severe, as shown by the red line. And finally, the public finances of the sponsor states interact with risk-taking through this risk-shifting channel that I'm going to explain next. Now, we are going to propose a model of risky portfolio choice. That's the first main contribution of the paper. So the assumptions of the model are presented on this slide. The public pension fund, so the public pension fund and the sponsor are the sponsoring local government, right, are one and the same entity, and they act on behalf of a representative citizen. What we mean that so we illustrate that in a simple two-period model. So in the first period, time zero, the public pension fund has a choice to invest in a mixed portfolio of risk-free and risky assets using these shares, 1 minus omega and omega. As a result to that, in the second period, at time t, the fund obtains the level of assets at time t are equal to the initial assets as of time zero, augmented by the gross return on the portfolio of risk-free and risky assets, whereas the return on the risky assets is related to the risk-free rate, but importantly, there's also this lambda here of a risk premium that reflecting the risk premium of the risky assets. And there's also a stochastic shock epsilon. I mean, the risky assets are risky, they provide a risk premium, but they can be good draws as well as bad draws on the risky asset. As I said, the pension liability is defined benefit. It is risk-free. It is guaranteed. It is widely guaranteed, at least the vested portion of liabilities. Therefore, the gap in the second period between the liabilities and assets, to the extent that a portion of liabilities is not covered by assets in the second period, the gap must be funded with additional tax revenue raised by the state and local government sponsors. Now, this additional, if it comes to that, and they have to raise tax revenue, that's going to diminish the consumption of the representative citizen, right? The optimization problem is that the public pension fund or the sponsors must choose omega, the share of risky assets in the portfolio in the first period, in a way that maximizes the representative citizen's utility in the second period. That means in a way that minimizes the possibility that tax revenue will be needed in order to cover unfunded liabilities at the funds. Very quickly, this slide only illustrates the three channels. So the algebra of the model comes down to this. So the maximization the maximization is equivalent to minimizing the possibility that what we've circled here in red is going to be higher than zero. If it comes down, if this expression here in the red square becomes higher than zero, that's going to that's going to be tax, that means that's going to be tax revenue to cover the unfunded liabilities. And this expression being higher than zero depends on a number of factors. So first, if the fund is underfunded in the first period, it's likely it's going to be underfunded in the second period. So they can either raise more taxes to cover that gap or invest in risky assets in order to make up for the funding gap by choosing a higher omega. So risk taking, the share of risky assets in portfolio omega, depend on three channels. There's the reach for what we define, the reach for yield channel, which is the impact of funding ratios on risk. So if the fund is underfunded, the higher the omega resulting from optimization. Second, there's a risk premium channel that operates through the impact of the risk-free rate on risk taking through the risk premium lambda. So the empirical literature establishes an inverse relationship between the risk-free rate and lambda. So a lower risk-free rate provides a greater incentive or a higher risk premium or a greater incentive for the fund to take risk. And finally, there's this risk shifting channel that I mentioned at the beginning. So to the extent that the sponsoring state or local government is already indebted, and this is debt that is unrelated to a pension fund. So this is non-pension fund debt. To the extent that state finances are already in trouble, the state has even more incentive for the fund to engage in risk-taking, with the understanding that if risk-taking leads to a negative outcome, the state can default on its non-fund debt and in order to free up resources and cover the unfunded portion of the fund's liabilities. And that happens according to this expression, especially if the default penalty is low, or if the amount of taxes to be raised, or if the pre-existing debt to income are high enough, or if the coefficient of relative risk aversion is high. To very briefly illustrate how the model works, so this chart shows the optimal risk taking measured by that fraction omega on the vertical axis as a function of the funding ratios and the risk-free rates shown on the horizontal axis. So the model, the optimization problem posed by the model results in the following relationships between these two drivers, right, and risk. Like a lower funding ratio on the horizontal axis is always associated with higher risk taking by the fund. Like, so the more underfunded funds should take more risk. Also, a lower risk-free rate is associated with higher risk taking by the funds through the channels that I just described. And also, there's an interesting interaction between the two drivers in affecting risk, in a sense that for lower levels of the risk-free rate, the slope between the negative slope between funding ratios and risk taking is even steeper. So the more underfunded funds take more risk, especially when the risk-free rate is lower. There's also an interesting interaction between public finances and the risk-free rate. So funds whose sponsors have weaker public finances as measured by the debt to state income on the horizontal axis. See, at a certain point, as a debt to state income increases, the optimal degree of risk jumps because of the risk shifting channel that I just described. If the state is already in a lot of debt, they do take into account the possibility that the possibility to engage in more risk, to let the fund engage in more risk, with the understanding that if risk taking results in a negative outcome, the state can default on the non-pension fund debt in order to free up resources and cover the unfunded liabilities. And also the risk-free rate, so when debt is high enough, again, the risk-free rate, as the risk-free rate decreases, that leads to a jump in the optimal degree of risk-taking by the fund. unless there are any questions on the model, I would go to the second main contribution of the paper, which is the way we measure risk in public funds asset portfolios. The data is limited. So we use the data from the Boston College Center for Retirement Research. We only have data, these data for 16 years at the annual frequency. So what we have is the total asset returns reported by the funds and portfolio weights for 6 asset categories for the funds in our sample, up to 170 funds. So this is very little data at low frequency. That is not it's not enough to measure risk appropriately, right? 16 data points of asset returns and like for 16 years by the fund, 16 data points at the annual frequency is not enough to measure volatility or risk in any way. So that's other papers measure portfolio risk for the funds using more coarse measures of risk. So such as the share of risky assets, or we do come close to a paper by Panaki and Rastad, where they use the value at risk while assuming funds returns in each asset category are driven by a particular market index. So we come close to that because our method described at the bottom of the slides is to use, to identify a mix of market indices. So we let the data speak for what is the relevant mix of market indices that are relevant for each asset class in which the pension funds are invested. And then once we identify the mix of market indices, we're going to use these market indices to estimate daily returns for each asset class in which the pension funds are invested. And using these estimated daily returns by asset class, we're going to compute better measures of risk, such as value at risk. So the method is summarized by this on this slide, the econometric approach. So first, the first assumption is that for each asset class C, so RCIT, this is the return of fund I on asset class C. So there are 6 asset classes: equities, fixed income, alternatives, alternative investments, right? So the return of fund I from asset class C is equal to a category index for the asset class that is common across the funds, plus the fund specific tracking error. And we further expand that the return on the category index. So this is a linear combination of return on a range of market indices, right? So there will be RJs. There will be a variety of market indices whose linear combination determine the return on the asset class. So then putting the 2 assumptions together, we are going to estimate this expression given by equations 3, where in red, we have color red the data that is available. That is, so at the annual, right, so at the annual frequency, the funds reported total, each fund I reports the total returns and the weights on 6 asset classes. So the expression allows to using the lasso technique to select relevant variables. So the method allows to estimate the thetas, right? In the panel of annual data, we estimate the thetas for each asset class and each market index. So the thetas provide the linear combination of the relevant market indices that explain the returns for each asset class in which the funds have exposures, subject to the data reported by the funds. So again, this is a method used to measure category or to estimate category index returns that is generally valid, so it can be applied to other financial intermediaries, not just the pension funds, in instances when the data is limited. Okay, and then using once we have the linear combination of market indices, we can switch to the high frequency space, right? We can compute daily returns, and we compute the variance covariance of category indices. And that allows to compute the value at risk of returns in pension funds portfolios using that variance covariance matrix and the fund specific weights for each asset class. Okay. And now I would briefly go over the empirical findings where we confirm, using our measure of risk, we confirm the model results or we test the model implications. So first, these scatter plots show on the lower right side, shows the relationship between funding ratios on the horizontal axis and the value at risk measure for funds portfolios. So in 2016, each dot here is a pension fund. So we see that funds with lower funding ratios took more risk in 2016. And we also do this estimate, we measure this relationship between our measure of risk and the three drivers in a panel setting. Importantly, we demean funding ratios, because otherwise they're trending over time along with the treasury yield, which is our proxy for the risk-free rate. The funding ratios trend over time, so we're going to demean them according to the year-specific averages. So that we are able to identify empirically the effect of funding ratios separately from the effect of the risk-free rates. So in a panel of funds over time, so we find what I circled red here is that lower funding ratios again are associated with higher risk taken by the funds, lower risk-free rates again are associated with higher risk taken by the funds, and the interaction is positive, meaning that the more underfunded funds take more risk, especially when the risk-free rate is lower, which is consistent with the model implications. And also, and I'm going to conclude after this, in this other specification, we measure the link between pension funds risk and on the left-hand side, and the risk-free rates and state finances on the right-hand side, as well as the interaction between the two. And now for state finances, we use either the debt-to-income ratio of the states sponsoring the funds, or where the funds reside, better put. And we also use the state bond ratings for the debt of the states in which the funds reside as an indicator of the strength of public finances. And what we find is again that lower treasury yields, lower risk-free rates are associated with higher risk taking by over time, right? Associated with higher risk taking by the funds. Also, weaker public finances are associated by more risk taking by the funds in those states, like a higher debt to income ratio is associated with higher risk taking, or a weaker bond rating for the state is associated with more risk taking, and the interacted term is negative. The coefficient of interacted term is negative, meaning when risk-free rates are lower, it's especially the funds from states with weaker public finances that are going to take more risk. So these findings are consistent with the model implications and support the risk shifting channel that we describe in a model where states with worse public finances are more prone to allowing the pension funds to take more risk in light of their sponsoring relationship. And we have a variety, we have a full set of robustness results that we perform, and the results are robust with alternative specifications. So we use the 5-year treasury yield in the main results as a proxy for the risk-free rate. The results hold with the 1-year treasury yield, also to a more limited extent the 10-year treasury yield, but the results are robust. And we use other measures to compute the value at risk or to rediscount liabilities with duration matched high quality corporate bond yields, for example. The results remain the same. The results would have been weaker with the more coarse measures of risk, such as by simply taking the share of risky assets in portfolios. Okay, and to conclude, that's what we have. We document the reach for yield behavior of pension funds, and and the paper. So we have a theoretical model that interprets the channels of risk to interpret the channels of risk taking by the funds, and we propose an innovative econometric approach to measure risk in the asset portfolios with limited data. So thank you very much. I'll be glad to take questions.
Very good, Andrei. Thank you very much indeed. So we're almost out of time. I'll just ask my panelists if they have any comments or questions they'd like to ask.
Well, maybe a quantitative question, like, so what does 0.2 mean on the VAR on page 13, right? You had like the constant was 0.2. Does it mean 0.2% value at risk?
I'm going to, so what slide was that?
Like 13, say, right? 13?
Oh, you mean the coefficient?
Yeah,
oh,
no,
so,
just because, I mean, the unconditional mean seems to be 0.2, right? Is that 0.2% value at risk is the general? And then just to get a sense, is the treasury yield, what order of magnitude can I think about? Is this like, is the treasury yield, is that measured in percentage points or?
I can speak for that. So first of all, the magnitude of value at risk. So if you look here on the horizontal axis, this shows the magnitude in 2016 for the value at risk, right? So a higher percentage. So the value at risk shows that say this is a 5% value at risk with a so let's say a fund with a value where the value at risk is 0.15. This is 15%. That means the probability, right, with a probability of 5% every year, the fund can sustain an annual loss in a portfolio of at least 15%.
Okay.
Okay. Now, when relating that to the treasury yield, say, so the treasury yield is measured in percentage points.
Oh, okay.
So that means if the treasury yield is lower by, say, by 1 percentage point, the value at risk increases by 1.4%. Or let's take the value at risk increase by 2%, 2.1% according to the results in column 1. Would that make sense? So if like a 1 percentage point reduction in the treasury yield coincides with 2 percentage points additional in value at risk, whereas the mean for 2016 was 15%, right? So that's quite that's sizable. Actually, we do have an implication for the implications. Like we see that the lower yields, in part also funding ratios, but this result is mostly driven by lower yields. So yields decline in the post-global financial crisis years. Yeah. The risk-free rates decline, say, by about 3 percentage points compared to the pre-crisis years. Well, that decline accounts for almost 25% of the risk-taking that we see in the post-crisis years. So this is to give a sense of the magnitude of value at risk, what it means, and also the relationship with low yields. I hope it helped.
I won't ask you to respond to this, but given the time, but just in the UK, we've seen like pension funds increasing their exposure in repo markets to take kind of levered positions in government bonds to hedge themselves against some of these interest rate risks. So it'd be kind of cool to kind of know whether that's happening in the US as well. But we're out of time, so I'm not going to let you respond to that. Let me just draw this to a conclusion. So I'd like to kind of thank all the presenters for I think really thought-provoking papers. I learned an awful lot listening to it, and I hope everyone else did as well. And hopefully, kind of the next time we do this, we can meet in person. So thank you very much indeed, all of you.
Okay, thank you.
Thank you so much. Yeah, thank you for. Yeah. I'm very glad I had this chance to be part of a session. So,
Thank you. Bye-bye.
Bye-bye.
Thank you. Bye.